Hey everyone, welcome to Property Finance with Lee. In today's chat, I want to dive into how you can use the value in your home to start building your property portfolio. If you own a home that's gone up in value and you're thinking about tapping into that value to get into the property market for an investment, you're watching the right video. Let's kick things off with an example. Imagine you bought a house years back for $700,000 and you had a mortgage of $560K, which is 80% of the purchase price. Since then, a few years have passed and your home's value has gone up. Instead of being worth $700,000, you think you could sell it for $1 million. That's what is known as the market value. Over the last few years, you've also been chipping away at your mortgage, so your debt is now just $500K. So as of today, your home is worth $1 million and your loan is $500,000. The big question is, how much equity do you have? This is where many people start to get a bit mixed up. Most people subtract the current loan amount from the estimated market value and come to the figure of $500,000, thinking that's their equity. In theory, it seems correct, but in practice, it's not that simple. When you want to access your home's equity, the bank will do their own valuation, often lower than the market value, typically 8 to 10% less. Let's call this the lender valuation. So instead of that $1 million market value, your LV might be $900K. Now, banks won't lend you 100% of your unused equity. They want to protect themselves, remember? They might go up to 80%. So in this case, that's up to $720,000 on your existing property. If we subtract your debt of $500K, you've got $220,000, which we will call available equity. In this process, it's important to understand the way banks manage their risk. Instead of thinking you had a massive $500K to play with, it's more like $220K in practical terms. Here's the kicker. The bank might not even grant you the full 80% based on their valuation. Why? Well, it boils down to your borrowing capacity. If, for instance, you're currently unemployed in the midst of a job transition, that equity you thought you had is essentially locked away and inaccessible. You can't tap into it unless you can convince the bank that you're capable of servicing the debt, meaning you can make those monthly repayments. There are a lot of gurus out there talking about unlocking your equity, but the truth is equity isn't some magic shortcut to getting rich quick. Just because you've built up equity in your property over a few years doesn't mean you can rush out and buy more property. There are rules and constraints you need to work within. To illustrate how you may achieve this, you'll need to budget for expenses such as stamp duty, legal fees, and potentially some bank charges. Let's estimate these costs at around $30K. Now, if we consider the equity you currently have, which stands at $220,000, and your borrowing capacity allows for an additional $410,000, you can confidently buy a property valued at $600,000 without requiring lender's mortgage insurance. This is because the loan-to-value ratio, LVR, would be 63%, well within the LMI exemption threshold. You're taking $220,000 out of your available equity and borrowing the rest against the investment property to secure it, which is fantastic. But let me point out something a lot of people overlook. People tend to calculate their interest payments based on the assumption they're only borrowing the $410,000 we talked about earlier. However, you are also borrowing the $220,000 against your home to provide the deposit and cover costs, so your total loan amount is increased by $630,000. When you're crunching your numbers, make sure your primary and rental income can comfortably cover these repayments, especially when you're concerned about cash flow, rental returns, and rising interest rates. Now, assuming that's all squared away, you may wonder, if you have the borrowing capacity, should you go back and stretch your available equity to an 80% LVR loan, $1 million loan? The answer to this question depends solely on your appetite for risk and your financial situation. I'm not giving personal advice here. I don't know your unique situation. This strategy requires professional consultation with your tax advisor and financial planner. The decision to use more equity hinges on your risk tolerance and your financial goals. So, moving on. You've got an investment property now valued at $600K and your principal place of residence. If you're looking to build a property portfolio, how aggressive or patient you pursue your next purchase depends solely on you and your situation. Just like how you used your home's equity, you can wait for your investment property and your home to increase in value and repeat the process if your borrowing capacity allows it. Okay, that all makes sense, but what if you want to continue purchasing with your accrued equity, however your borrowing capacity is depleted? Let's crunch some more numbers. Suppose a few years pass and both your properties increase in value by $150,000 each. That's a total of $300K in appreciation, which at 80% LVR translates to $240K in extra borrowing. Provided you have the borrowing capacity to take a loan against this amount of equity, how can you purchase without further borrowing capacity? Well, you can use a lease stock loan and purchase a commercial property. I posted a video a couple of weeks ago where I talk about lease stock loans in detail. I'll link it below, I suggest you watch it, but essentially a lease stock loan is judged solely on the income generated by a commercial lease on a property. There are lenders which will lend up to 75% LVR for a lease stock, which means provided the income covers interest by the lender's income interest ratio, you can borrow up to $960,000 on your available equity. Guys, the key to all of this is aligning the different facets of your financial situation with your property investment strategy. It is imperative to utilize the expert guidance of a tax advisor, a financial planner if needed, and a mortgage broker like myself to assist you with this strategy. Aside from leaning on expert guidance, you should carefully analyze your cash flow numbers. Ensure you're investing in areas with strong growth potential and consider that at some point, you'll need to pay back the equity you've borrowed against your properties. Whatever your path, the goal should be transitioning from using your home's equity and personal income to using the equity and income generated by your investment properties to keep building your portfolio. Don't go into this blind. You need to have an exit strategy where your portfolio becomes debt-free or at least independent of your personal income. This can be achieved gradually over time if your property's cash flow is positive, or perhaps your strategy may involve the sale of a property to cover the portfolio's debt. I hope this episode has given you some valuable insights into the power of equity and how to use it effectively. If you liked the video, please drop me a like and subscribe. And if you require expert guidance on your property financing, feel free to contact me from the details below. Catch you next time, guys. Thanks for watching.